Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have a returning guest. He is Jordan Trendsman. He is over at the Daily Gold. Thanks for coming on again, Jordan.
Hey Rahul, thanks for having me on. It's my pleasure.
Okay, so it's a new year, and we have to look at the price of gold. It was smacked down a little bit towards the end of last year, same as in 2011 as well. Now, going forward in 2013, we have guys like Bill Gross saying that 2013 is the year of gold, and we have a debt ceiling hike coming, and we could have something crazy like the platinum coin solution, which I don't think is going to happen, but I think there's going to be a Band-Aid solution. So do you agree with Bill Gross that 2013 is going to be the year of gold, and we're going to see the price of gold go up substantially, maybe to the 1820, 1830 range? I mean, what do you see about the trading ranges in the short term and then for the rest of the year?
Well, I would say as far as the year of gold, that's difficult to say, but my guess would be, I would probably say 2014 is more likely to be the year of gold, and but that doesn't mean I'm bearish on 2013. The reason I say that is what I'm kind of focused on right now is there's been a shift in the last year and a half, and I didn't first see this until around the May bottom, and then I picked up on this again a couple weeks ago. And if you go back to when we had the I want to say the Euro crisis, but there's been so many, I don't know what part, but if you go back to 2011, going back to August, when gold and gold stocks peaked, and of course silver peaked before then, but it kind of had it popped pretty nicely back to I think $45. If you go back to that point and you look at the charts, since that week that the precious metals topped, the gold stocks are down 32%. It might be about 33%. I'm looking at an old chart here, and I believe gold is down 14% since then, and silver's down 32% since then. But the S&P is up, I believe, 27% since then. So we've had a decoupling, and if you look at the charts, it's really obvious. Excuse me, because if you go back to, again, August 2011, gold stocks were at an all-time high. The S&P was, in August, the S&P was trading just slightly above 1,100, and its recent top was about 1,360. So there's been a clear decoupling since then. And what's really interesting to me is the exact same thing happened in the 1970s. If you go back to early 1972, the gold stocks made a peak, and then they went down for about 8 months or so, while the stock market continued higher for another 8 months or so. Then, essentially, gold stocks in the stock market, and you can say gold as well, traded in different directions up until, I believe, early 1978. So gold stocks had a raging bull market for about 2 years, and part of that was during the recession in 1974 and at the end of 1973. And then when the stock market bottomed and had a nice rally for about a year and a half there in the mid-70s, gold stocks came down, and they retraced a lot of their gains from the huge bull move they had. And then after that point, we had gold stocks started moving up again, and then the S&P had a mild bear market of about 20%. And then when you got to early 1978, that's when gold started to go parabolic and everything was going up. So, long story short, there's a decoupling going on. It's been going on since the end of July 2011, and since then, which is almost 18 months, or maybe it is 18 months, we have a decoupling, stocks have gone up, precious metals have gone down, specifically the stocks, and this is a repeat of history, as I just detailed. And the other thing I want to mention is during that 72 to 1978 period, when precious metals went higher, most of that time was when bonds were going lower. So this leads to my second most important point. First is the decoupling. The second point is if you look at really long-term charts of stocks and bonds, and you look at correlation charts, you go back the last 12 years or so, whenever there was a important top in stocks, around that time, bonds would make an important bottom. So they've kind of been shifting. I mean, remember bonds had that huge spike at the very end of 2008, then stocks had a bottom.
March of 2009.
Correct. Just to give you an example, and the same thing happened around 2002, 2003 period. Late 2002, the S&P bottomed, and then bonds had a peak in early 2003, and it wasn't a major peak, but bonds wouldn't exceed that peak for at least several years. I mean, if you look at a very long-term chart, it's very clear. And right now, if you look at like a correlation, like a 2-year correlation or a 4-year correlation, you have to look at it on a chart. But a correlation between stocks and bonds, a very, very long-term correlation, is very high. It's like at a 10 or 15-year high. So, in other words, I mean, and if you look at charts of bonds and stocks, I mean, bonds, it's hard to say if they've made the ultimate top or not. We don't know. But, I mean, I think cyclically speaking, stocks and bonds are probably, I mean, think about this in a very long-term sense. They're going to top together. Now, maybe that means stocks top and then, or maybe they're going to top together because, I mean, they've been trending up together, and from everything I'm looking at, I don't see how stocks are going to make a cyclical top this year, and then bonds are going to keep going up. I mean, it's just not possible because they both have been going up at the same time. And so the point I'm trying to get to, or maybe I've already made it, is I think these are the two most important things for precious metals this year, is that you have this decoupling, and you have a situation where we're just waiting for the decoupling to reverse. So whenever stocks peak, which I think is probably going to happen sometime this year, maybe it happens in like March or April or May, where there's a little bit more upside there. Maybe that's when we start to see precious metals regain some leadership. So essentially we have this decoupling, and it's still favoring stocks and bonds right now. Well, stocks specifically. And so in terms of precious metals, that's kind of what I'm looking for. This consolidation that we're in, I think it's going to continue probably into, the summer perhaps. And later in the year, in the summer or a little bit after that, that's when we could see the next explosive breakout. And so that's why, I'm sorry for the very long answer, but that's kind of why I say I think 2014 is set up to be the year of gold rather than 2013. And I mean, just to emphasize this it could be really spectacularly bullish. If we do see, cyclically speaking, we see stocks and bonds struggling or trending down. I'm not saying we're going to see some nasty bear market where the S&P goes down 50%. I don't see that happening. But just a situation where if you can't make money in stocks and bonds, then you're going to have to go into commodities. And I think that's really, we're setting up for that in 2014 and 2015. And so as far as precious metals, I think the risk reward certainly is excellent right now. I'm thinking that over the next couple months we could make a higher low or retest the lows. So we still have to be a little patient. But I mean, given all that, that's why I'm thinking 2014 is probably going to turn out to be better than 2013. But if I'm correct about this, we should finish 2013. I mean, the end of the year should be pretty strong.
You made a lot of points there, but what I wanted to get into is that you think there could be a decoupling moment. You have to look at the 1970s, as you talked about, the late 1970s, where gold just went berserk in 78, stock market went down, you also had higher interest rates around that time. This time around, we don't have higher interest rates. Interest rates could explode to the upside just like in Greece, but I don't see that happening right now with the Federal Reserve printing all of this money out of thin air. So how could you see this decoupling event happen? I know you're a chart guy, but if we have all these low interest rates, then the money is going to have to go somewhere, as you stated. It's going to go to the gold market, and I think it's also going to go to the stock market. What will prevent that from happening, all this money going to the stock market, if you just see interest rates rise? So what do you think about that?
Well, as far as the decoupling's already happening. I mean, I already laid out that it's been happening for about 18 months, and
No, after this decoupling event,
well,
you said that.
we're starting to see weakness in bonds, and I see your point. That is a good question, because we're seeing weakness in bonds right now, and I mean the money should be going into commodities, but it's not. It's going into stocks, and so I think that that is really the next thing to look for, is that at some point we're going to see the stock market run into resistance. And I don't know, the reason could be because when interest rates are going up, that just, as we know, that it makes the fiscal crisis even worse because of the interest on the debt. So, and also, we're just in an environment where, corporate debt, government debt, just household debt has been coming down, but nonetheless, we're just in an environment where the economy cannot withstand much higher interest rates. So at some point, with bonds are declining, interest rates are starting to rise. The money coming out of there is going into stocks. At some point, it's going to be negative for the economy, and then the feedback is bad for stocks. And then what's going to happen is the Fed and the other central banks are going to have to print a lot of money to force interest rates back down and to help the economy again. And that will be the catalyst for precious metals moving back up again. So that would be my answer for that. And they would force bonds back down, but bonds are not my area of expertise. But I would say, at some point the market will override the manipulation by central banks. They're not going to be able to keep interest rates down forever, because at some point they're going to have to let rates rise, because the more money they print, then the worse it ultimately gets in the end. So, but what I said there earlier is really, I think, my key point is that at some point, we have the money is moving out of bonds now, and it's only going into stocks because everyone doesn't see an inflation threat. That's happening, but what's going to reverse that is eventually rates will start to really higher rates will start to disrupt the economy. So then higher rates become negative for stocks, and then then we see the Fed and other central banks come in, and then ultimately that's when money should start moving back into precious metals and other commodities.
I agree with that outline, but I think it could take a little longer than what most people are saying, because you have to look at Japan. I always keep on harping on this topic, and the Japanese for 20 plus years have kept interest rates artificially low for a long period of time. And eventually, in my opinion, in the next 3 to 5 years, the Japanese economy is going to blow up, because they will no longer be able to keep these rates too low for too long. So, do you think that we could just kick the can even further down the road than what most of these libertarians are talking about, these Austrian school guys are saying? Or do you think that within the next few years we're going to see higher rates come up?
Well, I ultimately see higher rates. It is a very, it's a tricky situation But to your point, one thing I want to mention is that there is a huge bond bubble right now, but it's not in government debt. That's the misconception. The bond bubble is that so much money has been going into junk bonds and corporate bonds. That's where the huge bond bubble is. So when the economy starts to have problems, that could really start to burst first, and then a lot of that money is going to move back into government bonds. So that could be, possibly where I'm wrong. In other words, the corporate and junk bonds run into problems first, and so then that money goes into government bonds, and then the government then, or the central banks, I should say, then they have the cover to start printing more money, monetizing more debt. So that's a situation where that's why I'm not sure that bonds have already made the ultimate peak. They could have another strong move up at some point, maybe in the second half of this year or early next year. But going back to talking about the decoupling, precious metals were decoupled from stocks first and then bonds second. And also, if you look at the dollar, the link between the dollar, bonds, and stocks and precious metals, all three of those things were strong. I shouldn't say strongly, but they were really strongly linked to precious metals. But stocks during that period were by far the most. They were the strongest linked to precious metals. There were times when in that 72 to 77 period when precious metals trended up with bonds and also the dollar, and also vice versa. So I know I kind of went off on a tangent there, but I don't know if that answers your question.
Yeah, it sort of answers my question. But before I let you go, Jordan, how could people do business with you and follow your own work?
Well, they could go to my website at thedailygold.com. I have a free newsletter they can sign up for, and I also have a premium newsletter they can sign up for where I focus on the gold stocks and do a lot of macro technical analysis. We also have an add-on product where twice per month I do a global update where I cover everything: emerging markets, bonds, commodities, and all those markets and assets.
All right. Thanks for coming on again, Jordan.
Oh, thanks for having me. It's my pleasure.